This episode of the Old Dogs REI Network is brought to you by Mino Studio. Mino Studio is a pre- and post-production facility for all of your audio needs. Mino Studio's founder is an accredited audio engineer with top 40 and indie album credits. With over 30 years of music industry experience, Mino Studio can take your podcast from idea to reality. Contact Mino Studio at minostudio777@gmail.com for more information. That's minostudio777@gmail.com.
Hey, this is John Lee Dumas of EO Fire, and you're listening to the Old Dogs REI Network with your host and top dog, Bill Manacero. You must be prepared to ignite.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Okay, well, welcome to the Old Dogs REI Network. Glad you could all join us, and we're really looking forward to a great show today. With Jeff Greenberg. Since 2007, Jeff has been investing in multifamily assets in emerging markets. Jeff focuses on acquisitions, investor relationships, contract negotiations, business systems development, business management, and asset management. He is one that actually entered the multifamily investing later in life. I think it'll be interesting for a lot of us, that example myself, that started investing later in life, to hear about his experiences. At this point, I'd like to turn it over to Jeff. I know I kind of gave an overview, but we'd love to hear from you a little more specific about your background and how you got into real estate investing.
Well, thank you, Bill. The background was certainly not in real estate investing, and as most of us, we went off after school, went to college and got degrees and got our jobs and was trading time for money. I guess it came around in somewhere around 2005 when I was on a hike with an old friend, that he mentioned that he was going to be getting into real estate. And at that time, I thought, oh, okay, well, real estate, that means you're going to buy and hold a property and rent it out and try to buy some more. I didn't realize that there was many, many, many other ways in which you can invest in real estate. But from there, I started going to real estate events, going to real estate meetings, and trying to find out where I fit in and what I would be interested in doing. With limited resources, I had to figure out where my niche was going to be.
Now, what was your first real estate investment in the realm of looking at yourself, okay, I'm going to learn this? What was the first actual investment you made? Well,
I tried doing the single-family homes, but at the time I was doing it was not exactly the best of times. That was probably in about 2007, 2008, 2006. I was looking at investing in single-family homes, but the knife was dropping so fast that it was very difficult. I was trying to do fix and flips using the foreclosure process, but that was moving so slow. I looked at REOs, which is bank-owned properties, but the banks didn't know what the heck to do with all the foreclosures that they had, so they weren't letting go of them. So that wasn't working well. In fact, I put an offer on one property, and I asked for a $15,000 repair allowance, and 3 months later they offered me an $8,000 repair allowance, but the value of the property had already dropped another 20. So,
oh gosh,
it was a little tough to catch that knife. So I kind of started moving away from single family homes and looking at other options.
Did you actually do some flips?
No, I never did.
Yeah,
I never did any. The only single family I've really bought or sold was my own personal residence. So I never did do any flips. I was looking at that time, but as I said, the prices were so crazy. It just wasn't happening. And then I was introduced to somebody that was doing multifamily properties, and that excited me. So all of a sudden, I was jumping into that.
And so that process, I think all of us go through, which really involves sort of the education and getting the background to understand the dynamics of that type of investing. What did you do in terms of get yourself educated and start to feel confident to be able to go into that area?
Well, I'll tell you what I did, and I'm not going to tell you that that's the way I would recommend others to do it. But I basically went through a lot of the seminar circuit and spent a lot of money at different seminars with different gurus. And I did learn a lot. I met a lot of great people. But I spent a lot more money than is probably necessary for someone else to get started. And it usually isn't the way that I refer people to go ahead and get started.
So what was your actual first multifamily investment?
We bought a 5 fourplexes. We treated it as a 20-unit apartment, but it essentially was 5 fourplex properties. That was in 210.
Was that local, something in your neighborhood or your area, or in another location?
No, it wasn't. It was in Texas. It was in South Texas.
So just to clarify, Jeff is located in Southern California, the Camarillo region. So you decided to go out of state for your first investment. Was that something you were a little nervous about, or you feel pretty confident that you had the team or contacts in place that you could do that?
Well, certainly we were apprehensive about it, but the main thing is we went through all this training, and we had talked to people. We knew other people that were doing it, and so I mean, anytime you do any deal, there's that nervousness. But we were confident enough with our knowledge level that that we were able to do that.
Now, it seems like when you have to do that, at least from my experience, you've got to have boots on the ground. Did you build up a team there first? How did you do that?
I had met a broker that had been sending me properties for some time. I probably met him in 2006. Well, we actually didn't buy until 2010. So we've been in communication. He'd been sending me deals. The deals just weren't working. I needed certain returns. So I had a good relationship with him. I had met with him when I flew out to the area. I even stayed at his house. So we had that relationship that when he finally called me up and said, hey, this is the deal you've got to get, we were comfortable getting into it. He became my property manager, which eventually didn't work out, and we ended up changing property management. But certainly he was the main boots on the ground that I had at that point.
And he was the guy that brought you the deal too, right?
He brought me the deal.
Did you just make contact with him, just sort of prospecting for properties and maybe going through LoopNet or something? How did you actually find this broker?
I actually met him on LoopNet.
Oh,
I had met him on LoopNet through other properties that he had, and we tried to get into some of those, and those ended up not working. And so eventually we got this, but I did meet him on LoopNet. He's actually a California transplant. So
oh, really?
He's actually from Northern California, and so we had a lot in common and built a relationship.
Oh, that's great. That's so important, having contacts like that, people that know the area well, that can really get behind the surface of a lot of the properties that, on paper, they all look good. And but when you dig a little deeper, it's important to have somebody like that that understands the local market. Just out of curiosity, again, because a lot of our listeners are newbies, are considering investing in properties for the first time, what kind of criteria did you have going into looking at new investments? Did you have like certain key criteria, maybe the top 3 or 4 things that you had to have in place before you would even consider purchasing that property?
Well, we wanted either C or B properties, and if the listeners aren't quite clear on that, a C property typically is a blue-collar property, an older property. A B is usually a property that would be more of interest to more of a white-collar tenant. And then you've got your A properties, which is more of a luxury property. And then at the bottom end, you've got your D properties, and those are neighborhoods you probably don't want to go even during the day. So we focus mainly on C and B properties. This one happened to have been a B property. The properties were actually built in 2007 and 2008.
Oh, wow.
We were buying them actually in 2010. So the properties were beautiful. I mean, they were great properties. They were 100% occupied. We normally look for a cap rate, which is a ratio between the net operating income and the purchase price. Your net operating income is your revenues minus expenses. So basically that ratio tells us what kind of return we're going to get.
What kind of a cap rate were you looking for?
We're looking at an 8+ cap.
8+? Okay.
Usually like an 8.5 cap is what we're looking at. Basically, it's a conversation piece. It's something that you can communicate with a broker. If you go and tell them, oh, I want a certain cash-on-cash return, that's a variable depends on your loan. It depends on how much you put down, where a cap rate doesn't vary on that. It basically is what your net operating income is and what the purchase price. So it's much easier to talk to a commercial broker about cap rates. It's kind of a standardized terminology.
And what was the cap rate of this particular property?
I believe it was at an 8 cap.
It was 8?
And it was a little bit on the low, but it was a fairly new property, so we felt pretty good about it.
And was that consistent with other properties similar to it in that area?
In that area, most of them were trying to sell for a little bit a lower cap rate, which would be a higher price. And this happened to have been owned by the developer that developed the property, and they were lousy property managers. They didn't want to be a property manager. They were kind of stuck in their properties because the economy at that time. So they were stuck in it, and the bank wanted them out. And the bank was totally frustrated with fighting with them. They were 2 or 3 years behind on their taxes, and so the bank did everything that they could to get us into the deal.
Were they willing to do any kind of special financing?
Well, they were limited because of what was going on with regulations and stuff, but they basically brought us in as an assumption. Mm-hmm. They still had to consult with their regulator. Things were getting tight at that time because of what had happened with the economy. But he liked us and our resumes, and they did everything that they could to get us in. So, and it was a small bank. I think there was like 2 or 3 branches.
So you were able to assume the loan then?
They considered it an assumption. It's kind of weird. They considered it an assumption, but the terms were all different. So, but basically they wrote it up as an assumption, yes.
Okay. Were you looking for undervalued properties, that were maybe, 5, 10, 20% under market, or was that not a factor?
That's what we were looking for.
Uh-huh.
This one really didn't fit that, but we looked at it, and we syndicate the deal, and so we have to get a certain return so we can get that for our investors. And so the main thing is it fit into that criteria. And the value add was raising rents, which since then we've learned you don't rely on that as your value add. because when it doesn't happen, it doesn't happen. So, we went into it thinking that was what the value add was going to do, and we didn't get a lot of value add.
Were you able to increase the rents at all? Or?
Yes, we were, but not to the level that we thought. So our investors did well. We learned a lot from the whole process. It wasn't real lucrative for us, but it was a good deal. It was a starting point.
Sure. Well, you mentioned that you syndicated this. This is your first investment, and you syndicated?
Yes.
Wow. Now that's bold. It's one thing to buy out of state. It's another to syndicate your first project. That's amazing. How was that experience for you?
That was a good experience. We had to contact a lot of people and talk to a lot of people. The syndication part, as long as you know the rules, what you do and don't do, is not that difficult. It's finding people that are unhappy with their returns with the stock market or whatever they're invested in. And nowadays, there's plenty of people in that situation that their IRAs or their cash accounts are not doing as well as they had hoped, especially the ones in their savings account, getting fraction of a percent return. So we found enough investors to get that deal together.
Did you have a number of investors that were either in self-directed IRAs or similar type instruments that were investing?
Absolutely. On that deal, I think is maybe about 30% of the people are in IRAs. Each of our deals is a little bit different as far as the percentage, but in that particular one, I think there was probably about 30% had IRAs. The rest were cash investors.
Wow. Now, that was your first deal. Do you usually buy to hold, or are you looking to turn a property around in 3 to 5 years? What do you normally do, or is it just depends on the deal?
It's going to depend on the deal. Mainly, usually if it's a stabilized property, which is 90% occupancy, usually you're going to have to hold it for at least 5 to 7 years, maybe even 10, in order to increase the value and get the better returns. I'm still looking for a positioning, which would probably be a shorter hold, like a 3-year hold. Mainly because in that 3-year period, you can add value to it and sell it and get a good return for everyone. Where if you hang on to those type, you're basically going to dilute your returns if you hang on to it for a longer period. So it's going to depend on how much of a repositioning or value add property it is, how long you want to stay in the property.
Sure. So today, a number of years later, what are your current holdings? How many properties do you have, or doors, value, however you want to present it?
We currently control over 100 doors. Mm-hmm. I'm also invested in another deal that's got 700 doors. So,
wow.
So I'm involved with about 800 doors, but we essentially control 100 of them.
Okay. Now, from what I understand that, and maybe we could just touch on this just a bit, the one that's a 700 door, the fact that you had been an investor there, I understand, has helped you in other projects that you have tried to purchase. Is that correct?
Well, yes, I went into the 700 unit deal, which was like a $20 million raise, essentially as a passive investor. Mm-hmm. It was with somebody that I know had a lot of knowledge and I had a lot of respect for. And so I went in as a passive investor, mainly to learn, also to help out with credibility, so other people know that I'm involved in other endeavors. And the bank was impressed that I was in this other deal, so it did help out with the credibility. They know that you're just not a passing investor, that you really are serious about the business. So it did help. The other thing that I got out of that, I learned a lot of things not to do when I syndicate my deals. I think I learned a lot more about what not to do than I learned what to do with that investment.
Like, for example, just what are some of the things?
For example, how not to treat investors.
So I take it was the best experience in the world.
How to be transparent,
right? And
to understand the investor aspect of it, that you're being entrusted with your money, that you should be able to ask questions and find out what's going on with the investment, and not be given the runaround and that type of thing. To be totally transparent. If there's an issue, you let investors know early. Good, bad, or ugly. You should make sure the investors are informed on what's going on. And those are some of the things that didn't happen in that investment.
And this is, I think for a lot of people listening too, this is another form of real estate investing where you really don't have to find the properties necessarily, but it is a way to get involved. And generally, the interest rates that you earn, and in some cases, there's also equity if the property is going to be sold. It can be a great means for funds that you have in your portfolio that might be a consideration in terms of another investment source. But it was something you obviously were able to leverage in your pursuit of properties for yourself.
Absolutely, and I run 3 different real estate clubs, and one of the things that I talk to people a lot is you've got all different levels of real estate investment. You've got those people that want to be very active and are doing the fix and flips and are down there actually using the hammer and hitting away. And then you go all the way up to the other end of the non-active, the passive investment, which is the syndication, where the responsibility of the investor is to vet the sponsor and to vet the deal. And once they've done that, they've spent their time making sure that this person is a good person to work with. They've got a good track record. The property is an appropriate investment vehicle. Once you've done that, basically your job is pretty much done, except to attend conference calls and get reports and ask questions as you go along. You can be as involved as little as you want on a syndicated deal, where on the other end of the scale, where you're a fix and flipper, you're in it. You're out there swinging that hammer or hiring the contractors or whatever. There's a ton of different ways in between to be an investor, but those are probably the 2 extremes.
And from what I understand, too, the SEC rules have changed a bit, whereas in the past, you had to be a registered investor for a lot of properties, from what I understand. And nowadays, you don't necessarily have to be. And sometimes the price of involvement is even less. I mean, I know people that are buying into deals for $5,000 or smaller amounts and still get the percentage yield that a guy that invests a lot more has.
Well, the term that you're trying to get is accredited investor. Yes, the rules have changed. The SEC says that all securities need to be registered. If an investor takes your money and says, okay, I'm going to grow this money for you, we're going to split the profits, I don't care if it's 1 investor or 50 investors, the SEC considers that a security. All securities need to be registered, which could take hundreds of thousands of dollars and 6 months, years to register. So there is what's called a Reg D exemption. And so most of us follow that Reg D exemption. Now the rules that we normally go by, there's one called the 506 rule. It's now called 506B. And essentially what it says is we could only bring investors that we have a pre-existing relationship with. Now, that's pre-existing relationship prior to us presenting them with any kind of deal. So we need to talk to them about their investment philosophy, their strategies, what their risk tolerances are, and all kinds of stuff before we could ever show them any kind of deal that we're doing. Now, the rule that just changed said that we don't need to do that anymore. We could actually advertise. And that's under the 506C rule, which means we could advertise, but if we advertise, we could only bring in accredited investors. And the accredited investor is someone that for the past 2 years has earned over $200,000 with an expectation of earning over $200,000 the current year, or in conjunction with their spouse, have earned over $300,000 in the past 2 years, with an expectation of $300,000 for the next year, or they have over $1 million of net worth, not including their primary residence. So that's your accredited investor. So if you advertise, those are the only people you can work with. If you don't advertise, I could work with sophisticated investors, people that basically have enough financial business knowledge that they could properly evaluate the deal. They have enough smarts that they can look at a deal and see if it looks like it's a realistic and appropriate deal for them. So those are your main two classes of investors that you can do. Now, what you were talking about with the small $5,000 investments is the crowdfunding.
Right.
And the crowdfunding currently is only open to accredited investors, but give us a month or so, I believe in May, that's going to be changing. So a non-accredited investor may be able to invest in those kind of deals through some of the crowdfunding portals. So that's something that's changing.
Great. Well, thank you. That's great information. I wanted to ask you too, just looking at some of the things that you have done, some of the investments you've done, some of the properties. Maybe you could share with us your biggest mistake. I know we hate to zero in on the negative here, but I'll follow it up with a positive. Just sort of your biggest mistake and what you learned from it, what might be valuable information for those listening.
Mm-hmm. Anybody that's in real estate or probably any other business that said they haven't made any mistakes, is probably lying through their teeth. Fortunately, our biggest mistakes we managed to pull out of before we actually owned the property. As far as properties that we do own, and that also may have something to do with why we don't have as many doors as I would like, that I would hope for, but my business partner and I are very conservative, and we pulled out of, after being under contract and during the inspection period, maybe 6 or 7 deals that we saw ahead of time that there was problems with. And probably the biggest mistake I think that we had was on a deal, a 100-unit property we were looking in Colorado Springs, and it was actually being run as an extended stay hotel, but it was built as an apartment, so it had all the apartment amenities. I mean, they all had kitchens and everything, but it was being run as an extended stay. And we took the word of the broker that what we would be able to rent the units out once we converted it to an apartment. So our big mistake was not asking the question is how much was it going to cost us per unit in order to get to that point. And when we went out there, and we always shop the other units, we always go and look at other properties and see what they're being rented for and what they looked like, and compared it to what we were looking at buying, and realized that we would have to put $3,000 or $4,000, maybe even $5,000 into each unit before we were able to get the rents that were told to us.
Wow. And how many units was it again?
That was 100 units.
100 units.
So you take the 5,000 times 100 units, that adds up to some decent change.
Yeah.
And that wasn't the only problem with the property. It was a beautiful property, beautiful mature trees. Now, mature trees are wonderful. But those of you that have been involved with real estate, you know that mature trees can also be a big problem.
Plumbing.
And they were, exactly. And we had found out that, actually the sewer scope guy, there was 3 sewer lines for the 3 different buildings, and he lost his camera into one of them because it got jammed in there and he couldn't get it out.
Oh, God.
So there, right there all of a sudden was another big expense. There was other big expenses that we were unaware of until we were on the ground, and ended up walking away from the property because the seller wouldn't lower the price. But I think the biggest mistake was not asking the question, what's going to need to be done to those units prior to us taking over. We probably would have walked away from the deal before we spent the money traveling and going out there and everything.
Would you say it falls in that category of due diligence, that with a little more thorough due diligence, maybe it would have saved you, the sort of the later hassle?
Yeah, it would have, and we try to do that on all the properties. We try to find out as much information as we can prior to traveling, because obviously we want to conserve our expenses as much as we can, and so we do as much as we can from a distance. And then when we're all ready, we've got our financials. The financials look good. All the information we do have looks good. Then we go and travel. Because that's the expensive part about doing business out of state, is your travel and then your inspectors that you're going to have inspect the property. We pretty much learned that lesson. On my last property, which is actually in Ohio, the seller wouldn't go into contract with me until I came and saw the property. So we had a letter of intent, which essentially is a non-binding document saying how much we will pay for the property and some of the major points in the contract. And they said, well, we're not going to go to contract till you come see it. So I did go out there prior to going under contract, and I did view the property. I did most of my due diligence down there, and then when I came back, we went under contract. But typically, I like to be under contract before I actually go and see the property.
That's interesting. I haven't heard of that before, where a seller wouldn't let you go under contract till you see the property. Maybe they'd had some experience or something with somebody else. I wonder why that's the case. Interesting.
Well, there was 2 prior deals on that property that fell through. Mm-hmm. I'm not exactly sure on what reasons they fell through, but I mean, it helped us out because the seller wanted to sell. They already I think wasted about a year and a half trying to sell it. So the price we got at was much better than the price that they were selling at previously. So we ended up getting a great deal on that property.
Great. Let's look at your biggest success. What would you say a property that you purchased that just went really well and being just a great investment?
Well, it has to be the property we were just talking about, which is the property out. It's a student housing property out in Ohio, where I thought it was going to be a good deal. It wasn't going to be a great deal, but it was able to give good returns to the investors, and we would be able to make some money on it as well. And then I found a couple of value adds that all of a sudden boosted it up. We're in the middle of we're working on both of the value adds at this point. If we get the value adds we're looking at, this one's going to be a home run out of the park. But it's going to determine. The thing is, it's a stable property that's going to give a good return either way. But if we get these value adds, it's going to actually be a great investment.
Can you share what those value adds would be?
Sure. First of all, this is a portfolio of 8 different properties. Okay, and they're basically residential properties. There's 2 single-family homes, a duplex, 3 triplexes, and 1 building that is actually configured as 12 studio apartments. So the 12 studio apartment, the exact same building is right next door, which is also one of the properties, but that one's configured as a triplex. It's configured as 3 4-bedroom units. Okay, so I've got 2 absolutely identical buildings, one set up as a triplex, the other set up as 12 studio apartments. The triplex was just appraised at $240,000 more than the studio apartments was. And the reason for that is it brings in about $24,000 more a year than the studio apartment.
Wow, really?
So what I like about this is a no-brainer remodel. Mm-hmm. I mean, I love it when somebody's already proven that something could be done. All the time I get people say, oh, you put $3,000 into this unit or $5,000 into this unit, and you can go and get $100 a month more in rent. My question usually back is, well, can you prove it? Have you done that? Have you done it with any of the units? And sometimes you get a yes and sometimes you get a no. Well, it's already been done. It's already done. It's already there. So I don't need any proof. The only thing I had to do was do a little dance with the city to get them to approve my remodel, and we're waiting right now for the permits to be signed by the city, and we're about to go out to bid so we can do that this summer.
Great! Wow,
So anybody that knows valuing on commercial property, that $24,000 a year doesn't really add any expenses, so it's going to drop right down to my NOI, and so it will add probably somewhere around $280,000 to the overall equity in the property.
What about the cash flow on? Is it
well, it
less?
will increase the cash flow, yes.
Oh, it will for the four units.
It will increase the cash flow. Now, it could take us a couple of years before we get back our capital expenditure. Mm-hmm. But so it will increase the cash flow, but it also increases the equity.
Wow,
because of the way that commercial properties are valued. Then the other one is the single-family homes and the duplex are paying their own utilities, but we're paying the utilities on all the other units. So it's about $38,000 worth of utility costs. So we're going to have the students, they're going to start paying their own utilities. Now, we will have to reduce the rents slightly. So we're going to be reducing the rents on those units between $6,000 and $15,000 a year, but that's for a $38,000 gain.
Wow, that's great.
So right there is another between $22,000 and $32,000 increase to the bottom line.
Great move. Oh, and student housing too, which is I understand a real solid income.
Yeah. So then that with the ongoing increasing rents, basically is the third one. In my pro forma, I budgeted for 3% increase in rents. Between 2015 and 2016, our rents actually went up 11%. I did another pro forma on if we get 5% increase next year, that will be the third value add that will make this investment out of the park if my projections come true.
So you're talking a significant increase in value of the property in
absolutely, but
just a few years.
Yeah, but this is not typical. This is not typical, and it's the type of thing that you hope for.
Right.
So I'm just working to pull it off.
God, that's great. You didn't start in real estate. I mean, you obviously came from a different industry, started investing part-time, but there was some point where you obviously felt that, gee whiz, this is something I could do full-time or something I want to do full-time. Do you remember what sort of triggered it where you realized this is really where you wanted to go?
I went through a divorce in 2008, so I knew that there wasn't going to be sufficient funds to fund my retirement. So that was one of the main impetuses to get into real estate. And I'm still working a job, but that's something I'm hoping to retire from perhaps within the next year. Yeah, it basically just hit me that there wasn't going to be enough money for any kind of retirement put away. So that's kind of where it hit me, was at that point.
And you kind of started investing later in life, too. I mean, this is not something you started as a young guy. I mean, this was fairly recently that you began to purchase investment properties.
See, it was about 2000, somewhere around 2008 is when I started getting interested in real estate. And so I'm coming up on my 66th birthday, so I wasn't a youngster at the time.
That's great. Well, again, for a lot of our listeners, this is what I think is a great way for folks that are either pre-retirement or in their retirement years already to build that not only cash flow, but really create a legacy for your kids and future. So Jeff looks like is definitely living that. Well, I wanted to ask you one more question, and then I'm going to go into our wrap-up session here. And just looking at your current business today, what's the thing that's really exciting you about where you're going, and follow that up with, what's your vision for the future?
Well, I'm always looking for new deals, and I'm also run 3 different real estate clubs, and I go to many others. And I'm kind of excited about the people that gather around me. Over the time I've gained some knowledge, and so I start attracting a lot of people that want to get involved with me. And through that, I'm trying to spread my wings out where I get people bringing me more deals, because that seems to be always the difficult part, is finding the good deals. And the more students I get, or the more people I get involved with me, the better chance I have of finding those deals that I'm never going to find. In fact, this student housing deal was found by my 19-year-old intern, that I trained him how to evaluate deals, and he actually found this deal for me. So I see that in the future as more of people that are finding deals that they're not comfortable with doing themselves, and they bring it to me to help them get it closed, and we all share in it. So that's kind of what I see in the future. I would love to get rid of my 8 to 5 so I can spend my full time of my retirement doing more of this and getting more involved in it.
Do you see the student housing niche as something you would like to pursue more of?
Absolutely. I love the student housing niche. I'm real excited about it. At least with my property manager I have now, I'm real pleased with him. So I would love to have more stuff for him to manage. I would also like to find more properties in Houston for my Houston manager. When you find a manager, it's gold.
Yes,
it is. It's kind of, you want to find properties for them to do for you.
I want to stay in that market.
Yeah. Now, the other market I'm also looking into, which I haven't found a property in yet, is the self-storage. Self-storage is a very good investment as well.
Yeah, that's what I understand. I know some folks that are doing amazingly well there, and you don't have to deal with tenants. So
exactly, exactly, and it's a lot easier to lock people out if they're not paying, and the evictions are a lot easier on self-storage.
Wrap-up session, and in this I'll ask you a number of questions fairly quickly, and so that you can respond, give some good information to people that want to pursue more education and more information on real estate investing. So I will start first with your favorite real estate book.
Well, I don't know if I have a favorite book, but I mean, if I say the one that got me started and got me thinking in the lines, it's probably the one that everybody else has said, which is Rich Dad, Poor Dad, which actually, changed my paradigm and made me thinking that I could be an entrepreneur, I could do something on my own. I had always been focused on a career, a 9-to-5 job, working for somebody else, and that is the one that kind of said, hey, you really don't have to be, that there's other ways of doing things. That one was the one that kind of pushed me over the edge.
Hit me too, same way. What about favorite business book, general business book?
The E-Myth is probably one of the ones, another one where more of a paradigm shift in that, talking about, working on your business instead of in your business. I've seen that many times, even with my old business partner. It was always that we were so busy down into the dirt that we really weren't overlooking what was going on in our overall business. And so I always thought that was enlightening.
Michael Gerber, that's a great book too.
Yeah.
What about most valuable website outside of your own that you like to go to for real estate information or information for your real estate investing?
Well, I spend a lot of time on Bigger Pockets. A lot of that, I think is great for a lot of beginners. But there's information out there, but that's probably the one best for getting real estate information. I listen to a lot of podcasts besides the Bigger Pockets. There's a great one for those interested in commercial is Old Capital.
Yes.
They do a great job of it. Joe Fairless does a great podcast. I'm looking forward to listening to your podcast coming out.
I'll be added to your list, Jeff.
Okay, add that to my list. But the podcasts, especially if people spend any time in the car or I spend more time on those than actual websites. So I guess that's kind of my answer.
Yeah, same here. And that one kind of runs over into the next, which is the favorite app. Not to skew your answer here, but definitely my podcast app and my phone. When I get in my car, that is something that I turn on right away as well. But do you have a certain app that you use as well in your investing?
Well, besides the podcast, which is probably number one, I use Evernote just to kind of keep notes and stuff. I find that at least with Evernote, I can have it on my phone, I can have it on my computer. So wherever I am, the notes are there with me. Actually, the one I use even more, that's even more important to my business, is Dropbox. Dropbox is my life. I used to keep a lot of my data and my files on a flash drive, mainly because I didn't like to just keep them on a computer. I mean, I have my desktop computer at home, and then I take my laptop with me, so I don't want to have it in one place. So I used to do it with a flash drive, but flash drives can get corrupted. My hard drive crashed on one trip, so I was glad I had nothing on my hard drive. But with Dropbox, it doesn't matter. They're backing it up. It's protected up in the cloud. I can get it on my phone. I can get it on my computer, my iPad, anywhere I want. So all my files and all my stuff is stored up there. The only thing I don't put up there is confidential information that I keep on a secured flash. But Dropbox is probably one of the best resources. You know, any of the cloud resources that you can access. You know, someone steals your computer, what are you going to do?
Right.
You know?
Right.
But if it's up in the cloud, you can go to a computer anywhere and log in.
Just one last question as part of the quick wrap-up here is, given what you know, the information that you have, if you had to start all over, and let's say you only had $1,000, what would you do to launch your real estate investing business?
With $1,000, for the most part, I'm not sure that I would even need the $1,000. It's mainly if I still had my network of people, if I still had my relationships. I guess the $1,000 could be used for my first flight out to a property. But for the most part, you know, it's the relationships that I've built. I mean, somewhere I heard somebody ask that similar question to Henry Ford, and you know, basically the knowledge is the most important thing. There's other people that have money that want to invest with you or to loan you to do different endeavors, and $1,000 isn't going to get you too far. But if I didn't have the knowledge, I'd be buying books or audios or whatever. But for the most part, it's the resources I have in my head that are going to, you know, help me out.
Right.
I think that answers it. I don't know.
Yeah, no, I think
that answers the question.
Yeah.
$1,000 isn't going to go very far. I mean,
yeah, no.
I know in Bigger Pockets, a lot of times people are asking, you know, okay, what would you do if you had $100,000?
Right.
Well, $100,000, you might be able to do some things.
Right.
$1,000 isn't going to get you much. It's not going to get you marketing materials. It's not going to get you, you know, a website. It's not going to do much.
Right.
But if you've got the same knowledge that you had, if I lost everything and had the knowledge, you know, there's a lot of things that I could do, you know, with the network of people that I know.
Sure. That's key. And I think the fact that you've got these investing groups that you are involved in your area, networking is such a critical component to this industry that you definitely can leverage a lot of that. Well, Jeff, I know we went a little bit longer than I anticipated, so I thank you for hanging in there with me. What great information. Gosh, you've really done some neat things over the years, and I would love for folks to know how to get a hold of you. If you could just give them some general information, how they could do that. Maybe they'll even join your groups, or you never know.
Mm-hmm. Well, one of the places I'm always on Bigger Pockets, so you can always contact me there. But also my email address is jeff@synergetic.com, and that's spelled SYNERGETIC.com. That's for Synergetic Investment Group.
Great. Your website as well.
Just synergetic.ig.com. will get you to my website.
Great. Well, Jeff, I can't thank you enough for taking the time to meet with us and share with our listeners. We're called the Old Dogs REI Network, and I always tell people, I say, you don't have to be an old dog to listen. I'll be the old dog here, but we do ask guests that come on. We put them in a precarious position here, is that we kind of like to close out the show with a real good old hound dog howl. And I'm wondering if you could just leave us with that as a closing goodbye to all our listeners here. That was great, Jeff. Wow. Okay, that's going to go into our annals here of one of the best howls we've had in a while here. So,
first time I've been asked for that.
Well, thank you again, Jeff. You have been absolutely a fantastic guest. You've provided so much information. Wow. I think this is the kind of show you're going to have to listen to a couple of times just to take notes. But thanks, Jeff. Listeners, stay in touch with him and, check out Bigger Pockets, where you will see Jeff as well. He has written a lot of great things, especially in the forum area where I've read some of his things as well. And one who's on other podcasts. He's very popular in this industry. So thank you all. We appreciate everybody, and have a blessed day. I just wanted to take a moment just to thank you so much for coming by and listening to our broadcast here at the Old Dogs REI Network. We really appreciate it. We know there's a lot of things you could be doing with your time right now, and the fact that you have chosen to come here and listen to our podcast, we are very appreciative. As you know, we're a new broadcast, and we really want to get the word out and let people know what we're doing. So hopefully we can be a resource to help those that are pre-retirement or retiring, that are looking for ways to build their cash flow. One of the best ways that you could help us out is to go to iTunes, look up Old Dogs REI Network, and that's spelled DAWG, and subscribe to the podcast, listen to a podcast or two, rate them as a 5-star rating, and leave a review, write a little review, and we'll be monitoring those and reading them every now and then on the show as well. You could take the time to do that. We would really be grateful. Thank you so much, and have a great day.